And today we are talking about your trading strategy. Now, this is definitely one of the most important lessons from throughout this entire course, so definitely stay with me here. Now, what is your goal? That's where we're going to start, and that's the main objective here. And what I mean by what is your goal? I mean, what is your time frame? How much work are you willing to put into this, and how long do you actually want to hold these stocks? Now, an answer of 6 to 8 hours because I want to day trade is perfectly fine. Or if you want to hold for 1 to 3 years or even longer, it's totally fine. What really matters is what is the best fit for you. Second on that is what kind of return are you looking for, and the other side of that is how much risk are you willing to take. Usually when you can get a higher return, there's a slightly higher risk for that. So being able to balance both of those is something you really need to consider in your mind when you're talking about what your goal and what your trading strategy is. After that, how much effort do you want to put into monitoring your trades, keeping up with the companies, and really following the stock market? There's a lot of ways to do it where you don't have to do almost any research, almost any work on it, and you can kind of just take the easy road and not have to do a whole lot or apply a whole lot of effort. And there's also ways where you can get great returns and really track the markets and specialize in a certain industry or company and really do quite well. So lots of different options there, but you really need to kind of focus on how much you're willing to put into this. And then afterwards, what industries do you want to be in? Do you want to support fossil fuels, oil and gas, or do you want to focus on renewables? Do you want to focus on a certain type of initiative and a certain type of industry where you want to actually apply your money and specialize? Or are you just looking for the best return? Are you looking for the best trading opportunities? What are you actually going for, and where does your heart lie? So these are some of the specifics I mean by what is your goal, and now we're going to dive into it a little bit. So how do you get to your goal? Well, that comes with a plan and routine. So what is your trading plan, and what routine are you going to follow to execute that trading plan? Now, the key here is to actually write it out. So what we're going to do over the next little bit here is we're going to go through 3 trading plans so that we can see what they actually look like. Now, depending on how much time and effort these trading plans require, then you build a routine to help yourself basically follow through on that. If you're looking for long-term, real heavy, steady dividend flow, then you probably only have to analyze once a month, once a quarter. But if you're a day trader, you're going to be on this every single day. So how much effort and time you put into this and what routine you build is completely dependent on what your goals are and what your strategy is to get you to that goal. So first things first, let's look at a couple of trading plans. Here we're going to write them out. We're going to look at our time frame, the industries we want to be in, the percent of your portfolio you're going to make per investment or per stock, when you're going to buy, when you're going to sell, and any strategies you can think of to mitigate your risk. So strategy 1, we are going to be a 1 to 4 week swing trader. We are looking for changes in the market that we can get into and get out of within a 1 to 4 week time period to get some quick returns. We're going to focus on industries like renewable energy, technology, pharmaceuticals, and cannabis. And we're only going to ever invest 5% of our entire holdings into one stock at a time. So we could have lots of stocks out there, up to 20 trades live at a time, all on a 1 to 4 week time period. And we're going to buy when all of our indicators and trend lines show buy signals, and we are going to sell when 2 out of 4 indicators or trend lines show sell signals. Now, clearly, this is a very oversimplified trading plan. There's a lot more to this in terms of detail into each of these points. But here's the summary: is you're going to be a short-term trader that's basically trading off of indicators. You're investing 5% of your return, and you're focused on 4 or 5 different industries. That's a solid trading plan. That's a great way to start, and now you have to build a routine that helps you capitalize on that. So that's just one option and one kind of perspective. Second perspective we're going to look at is a 3 to 5 year dividend investor. So the dividends, remember, are the profits from the company coming out of the company and being paid back to shareholders based on the percentage of the company that you own. Now, the 3 to 5 year dividend investor is going to basically be buying companies that he thinks are steady and consistent and are going to always pay that dividend and are hopefully going to increase that dividend over time because he's using that as steady cash flow for himself or herself. They're going to invest in industries like technology, transportation, energy, and consumer packaged goods. They're looking to invest 3% of their entire holdings in each position, so they could have up to basically 35 stocks. After that, they're going to buy on any oversold period as long as the dividend is safe. So what that means is that If a company is chugging along, their price is steadily increasing, and then all of a sudden it plummets and it goes into the oversold territory, even though the fundamentals and the finances of that company haven't changed and that dividend is still safe and expected to be paid out, they will increase that position up to 3%. That's what that buy is saying. And then they're going to sell when the dividend becomes unsafe or the stock is overbought for over 60 days. So if that dividend ever becomes questionable, that the company might not be able to afford or pay it, or the stock becomes overbought and the actual price of the stock has gone drastically up for over a period of 60 days, they're going to sell those stocks and take the gains. Now, this is another strategy. It's a much longer term strategy compared to the first one. They're focused on a different goal. They're focused on cash flow and dividend income as compared to capital gains by getting in and out of stocks at the high and low of the swing. They're also only holding 3%, so a much smaller proportion of their portfolio is going into each stock, so they're much more diversified. That is one of the ways that they're mitigating their risk in this portfolio. They're much more diversified so that if one industry tanks or one company tanks, they have others that can hopefully hold it up. They're going to continually buy until they hit 3% as long as that dividend is safe, and they're only going to buy in the first place if it has a dividend that they think is safe, consistent, and is going to grow over the 3 to 5 year time period, and it is in one of the industries that they outlined, and they're going to sell when that stock becomes unsafe. So completely different strategy than the first one, and once again we have another strategy coming up, strategy number 3. This one's different again. So this is for a 2 to 6 hour day trader. This is somebody that wants to get in the morning and out in the afternoon and make money that exact day. They're going into any stock that they can find, that they have some knowledge in, that they see a trade developing, that they see support on, that they want to act on, or they just see a trend in the industry coming, or news for the day. Companies releasing financials, interest rates are changing for banks, anything along those lines. So they're looking to invest 10% of their basically entire holding into a stock, so a much higher investment and as a proportion of their entire portfolio, and they're going to buy when all technical indicators show buy signals, and they're going to sell when the stock approaches the next resistance level. So what that means is they're looking to get in as much as they can, and they are looking to get out at the first sign of basically resistance so that they can just capture those gains and lock it in as a trade that wins them for the day. Because they're investing 10% of their portfolio, they're going to be less diversified, so they have more risk, but because they're selling at the first resistance instead of an event or something else happening, they're selling at the first level of resistance, so they should be able to get out as soon as that stock tries to turn around right away. Strategy 3 would probably also be trading with a stop loss, which is basically a trailing trade that executes as soon as the stock tries to turn around. So we'll be following that in another lesson here, but as you can see, we have 3 different strategies all written out here with the same points, but completely different time frames, completely different strategies, different industries, and completely just different mindsets for who that investor is. So what you need to do is figure out, are you going to be a day trader, a swing trader, a long-term dividend trader, or are you going to go with some combination of all 3 of those? That's the real trick here, and then you can use the technical analysis that we've looked at over the last little while to apply to those trades. So in summary, you need to clearly define your time frame and your objective or your goal. You need to put together a strategy before you make your trade. So how long are you going to get in the trades? How much are you putting into each trade? What is going to make you buy? What is going to make you sell? And what industries do you want to be in? Those are the key things that you really need to look at. And one thing that you need to always think about is, this quote has always stuck with me. I think Warren Buffett said it, and he said, when you buy into a stock and the price goes down, do you buy or sell it? Well, you need to think about it like this. If you go to the grocery store and you were going to buy deodorant and the price goes down, you weren't wrong. That price is now on sale. And so when you buy a stock and you were willing to buy it at $100 and it's now $80, but you've already bought it, is that price now on sale, or were you just wrong? So think about it that way. When you buy and you get into a stock and the price goes down, is that stock now on sale, or did you just make the wrong call? And if you made the wrong call, you need to correct that right away. And if the stock is on sale, you should probably buy more. So think about that as you go into the next lesson here. Thanks. Talk to you soon.